Welcome to It's the Economy. The grammar for the Indian currency and bond markets has changed overnight, very sharply, after the announcement of the imminent signing of the US-India trade deal. Now, how do the macros change? How much more can the rupee rally? And how does this change the playing field for the RBI at its Friday policy? Joining me to discuss these are Santanu Sengupta, Chief Economist at Goldman Sachs India, and Chandresh Jain, the FX strategist at BNP Paribas. Gentlemen, good morning. Thank you very much for your time. Santanu, how does it change the macros? Are you going to up the growth forecast? Are you going to change your view of even bonds, as the amount of money moving out of India will probably decline?
Yeah, I think the clear positive is Indian growth, although the details are unclear at this stage. So what we know is a couple of Truth Social and X tweets, and the release from the PMO has come in only about half an hour back, but it doesn't really have details of how the deal is going to look like. But what is clear is that we are going towards 18% from overall aggregate 50% tariffs. So I think there's some clear upside to growth. We had not baked in the incremental or the additional tariff of 25% because of Russian oil purchases in 2026, because our view was that we'll get a deal done by Q1. But still, on the first 25%, the reciprocal tariff coming down to 18%, there is some upside to growth. On rates, I think this clearly means, in our view, that the RBI is done. I mean, in any case, our view was that the RBI doesn't cut from here on, but we had a risk case where the deal doesn't get done. And in that kind of a case, if growth, if there's a further downside to growth, the RBI could be moving maybe 25 basis points further. We would say now that that's out of contention, because the RBI, we think, now stays on hold. They'll stay on neutral. They will try to do whatever is required in terms of providing liquidity, but no further rate action is what we would be making.
Would the need for liquidity also decline somewhat, Shantanu? After all, there was dollar deposits moving out. That it detracts from the deposit growth. So, is there some kind of more liquidity available?
Yeah, I think on balance, what you would find is that the requirement for incremental OMOs can come down if you have FX inflows or lesser outflows. So whichever way you cut it, if the net FX is positive for the economy, you will just have lesser requirement for either doing OMOs or doing buy-sell dollar swaps.
Okay.
But remember, we still have a close to $65 billion worth of short forwards, which in our view, the RBI will try to knock off and come to a more reasonable number, maybe around $30 billion or $40 billion odd. And therefore, we would expect them, that dollars to not necessarily hit the market, and we won't bake in a large amount of FX appreciation.
Okay.
But I think the pressure that you've had on the currency and on liquidity, as you pointed out, is going to be clearly lower if you have FII inflows. Okay,
well, that's clearly up Chandresh's street. Chandresh, what are you looking at in terms of rupee levels? One factor will be what Shantanu is saying, the FX swaps that are open for the RBI. And the other factor is that RBI anyway has been against volatility on both sides. So your range and your reasoning.
Sure. Thank you, Latha, for having me on the show. I think the new range now should be around 88 to 89. So we still see more appreciation on the INR now after the deal has done. Secondly, I think once we go to 88, 89 kind of levels, RBI might try to hold some of the dollars which will come to the Indian markets. They will try to increase their FX reserves and decrease their forward book where they are short. So I don't think it's a big rally, which you should expect, but a little bit of more rally towards 88 is it's definitely possible from here on.
Okay. Now, when we were sitting on Friday last at 91.99 and the RBI holding 92, we will take 88 with both hands. But Shantanu, will the Reserve Bank be so worried, or rather, won't it be worried if it goes to 88? Would it not rather keep it a little south? Because there is an advantage if the currency is low but stable.
Yeah, our view is exactly what you pointed out, Latha. That we think that the RBI will refrain from an excessive appreciation in the currency, and they will try to either build reserves or knock off the forwards. Is what our view is. Because you remember the first part of the currency adjustment was the adjustment in the RER, which was quite expensive around the same time last year, and you've corrected now to about 95 odd. And our view is that the RBI would not like to let it appreciate meaningfully further, especially at a time when you would want to shore up your external balances. So our view would be that they will try to hold the line around 90 to 92 and not let it appreciate much further.
Okay. Well, today that seems to be the behavior, but of course I'm only picking up from dealer chatter. But Chandresh, did you hear of the Reserve Bank today buying dollars? And secondly, you're betting that FPIs will come. What has changed now is the sentiment. And maybe in a sense, the export flows because we expect them to resume what could have been, outcompeted. Is there a guarantee that FPIs will come? I mean, they can still find arguments like no AI stocks or expensive Indian valuations. Are you betting on the FPIs returning?
Okay, so two parts of your question.
Yes.
Firstly, I don't think RBI is there in the market today. I think they still want to see more appreciation. And I say that with confidence because a couple of things are happening. One, with this, sentiment will change a lot. India's sentiment was very, very weak, especially from the foreign investors. They were worried about currency depreciation. They were worried about Indian equities getting sold off quite quickly. With this, I think both the things can benefit. Some flow will come back to Indian equities. And my sense is that with this, the growth number also look better, which means the earnings will also look better, which means foreign investors would like to have more Indian equities in their portfolio. And then the currency appreciates on the back of that. That's why I said 88 to 89.
Okay.
Secondly, if you observe, the oil prices have also dropped in last couple of days. Gold prices have dropped in last couple of days, which will also help the trade balance. And therefore, it aligns the perfect environment for INR to appreciate.
Okay.
And the last thing I would point is, typically March is one of the month when a lot of corporates repatriate their foreign income to onshore because of the fiscal year end in March. So that will also benefit INR.
Oh, absolutely. Many people were hoping to pencil in a BOP surplus for the Jan-March quarter for the reasons you are saying. But the January behavior has, made people change their mind the way in which the rupee fell. Santanu, what's your sense? Two macro questions for you. What are you betting on in terms of a BOP surplus this quarter and FY27? And secondly, how much does growth improve? After all, we tightened our belts, reduced costs, sought new markets when we were faced with the adversity. This could be payback time. So how much can you add to macro GDP growth numbers?
The growth one first. If you look at the tariffs getting reduced by about 7 percentage points, and I'm saying 7 percentage points because we had not baked in the incremental 25% additional tariffs from the Russian oil purchasers, that would mean anywhere in the region of 10 to 20 basis points directly from the net export channel. But the bigger sentiment change would be boosting, with a lag, of course, the private capex cycle. I think the conversation about realignment of supply chains, investments back in India for those kind of realignments of the supply chains had sort of died down a little bit in the last 2 or 3 quarters. And now that you have the trade deal, I think some of those conversations will come back on the front foot, and these capital commitments will possibly start coming in, albeit with a lag, possibly in the second half of the year. So you can have a little bit further growth upside from there. Again, we had estimated about 30 basis points drag just from investment uncertainty last year. So some of that will start getting reversed. So medium term, we think this is quite positive for growth. On the first part, which is the balance of payments, we'll have to look at the details of the trade deal to understand what exactly the impact on the current account is. There are some import channels which we will open up also possibly, right? Because you're bringing down your own tariffs or opening up your markets in some of these segments. The second is that if the oil markets are going to shift now a little bit, that Russian oil purchases from India is going to come down, and we are going to import from elsewhere. The net effect of that is also going to matter. So on the current account, we think about 10 to 20 basis points maybe in terms of upside, and on the growth also we would think anywhere between 10 to 25 or 30 basis points of upside, depending on at what point of time you bake in the upside from the investment channels.
Okay, fair point. This calls for a longer discussion, but out of time, we have a string of guests and analysts lined up. Thank you very much, Santanu and Chandresh, for throwing more light on how we should look at the macros. 25 to 30 basis points higher GDP when we are standing at some, 6.7 average on the street for FY27. The chief economic advisor is saying 6.8 to 7.2. Now, I think people will move to the higher level of that band in terms of GDP. That's good news. We wrap up on that positive note. Chartbusters coming.